Hello everyone, I hope you are all doing fantastic on this Monday morning. My name is Marcello Colax and I'm walking you through the European energy markets today. The other day someone asked me when I'm actually filming these, so just to let you know, it is 5:31 on Sunday morning here in Singapore, so I'm always trying to get them out as early as possible. Okay, so what we did see last week was the market spiking dramatically with the Israel-Iran crisis almost like boiling over, and there was some fears that the Strait of Hormuz might not be accessible anymore anytime soon. And there was rumors that Iran might be mining this whole area, denying access. We even saw some vessels doing a U-turn. It was really fun to see on the tracker, but overall now these tensions have eased a little bit, at least around the time when Trump called it a 12-day war, which is now dragging on into quite a few more days, I believe. So tensions have eased a little bit, at least in the markets, and now everyone is wondering what's next. So here's one thing that I want to talk about before we go into the charts themselves. Of course, the European energy markets have become a lot more global over the past couple of years, simply with LNG playing an increasingly important role, especially since the war in Ukraine started. I know, it's a hot take. It's nothing new, definitely not. But what it does mean for European energy traders is that they have to start paying attention to more and more news that previously maybe wasn't on their radar all that much. So here's the thing, I'm probably the last person to tell you this. Of course, in the past it was a lot about storage sites being full or empty, or being not as full as they were last year around at the same time. And I have a fundamental background, so I remember very, very well that a lot of my analyses and articles that I wrote revolved about the week-on-week storage fullness. I don't know about you, and you actually have to tell me, because I'm a little bit out of it, but I feel that European energy markets are less reliant on storage fullness as an evolving story that needs to be covered every single day. Of course, storage site fullness is super important, especially in the shoulder seasons, and it does matter. But now for the day-to-day, it has become a little bit more background noise. What has become more important is LNG imports. So it has become increasingly important, not just over the past couple of years, but let's say 5, 6, 7 years. Now, that also means that the news about shipping lanes has become increasingly more important. And whether or not a shipping lane is open usually has to do with some regional conflict or global conflict or policies or just politics or economic forecasting. So that means that European energy traders now have to start, or they had to start paying attention to that a couple of years ago now. More and more these political or policy changes are more reliant on what is happening, of course, in the big states like the US, for example. And what's happening in the US right now has a lot to do with what Trump feels like in the moment. So that means that now all of a sudden we have European energy traders who have to pay attention to the latest ex-post from President Trump. So although some classic fundamentals are of course still important, so maintenance schedule is not going to decrease in importance anytime soon, weather forecasting has become incredibly important, and I do feel there is a lot more providers out there, absolutely. So the regional supply and demand balance is still very, very important. But on top of that, I believe LNG, and by extension politics that has previously been background noise, is now coming to the forefront. All right, this was just my little observation. Let me know in the comments what you think. But today is all about the European energy markets, and before we get started, of course, as always, a little reminder, everything you see here is just my personal opinions and of course not an invitation to trading. So overall, the outlook for the start of this week is still fairly bearish, so it hasn't really changed all that much. So what we are seeing here is that everything, TTF, NBP, the front months and the front season contracts, German power, EUAs, Brent, JKM, like everything is bearish, and there is no change to it to be seen anytime soon. Why do I think that bearishness is most likely to continue? Well, first of all, we'll look into the charts themselves. But if you are just looking at the Clever Markets dashboard that is available to our clients, of course, we usually observe that the lower level time frames, so the hourly chart, moves first before the daily chart does. So as soon as we start seeing the hourly chart turn from bearish to neutral and then bullish, then we could assume after that we start seeing that the daily chart is turning from bearish to neutral to bullish. So this is always like a little bit of a bellwether, and you can see how it is filtering through the market. So this here is what it was last time we assessed the market, and this is what it is now. And you can see, like, week on week we turn from bullish to neutral for a lot of these markets. So you see how the bearishness is filtering through. Now we are turned from bullish to neutral on the weekly chart, and next time around, if this bearishness is maintained, then it will turn bearish as well, right? So this is how I like to use it overall. Now, although the results are not out yet, it is fairly certain that this year will not change anymore. Right now, at the time of recording, it is 150 people have responded here. This is usually a little bit below the 200 people that tend to respond, but you can see the balance of the bulls and the bears is fairly all right. So it's 36% for the bears and nearly 31% for the bulls. The neutrals are in the 26-27 region, and there's quite a few people who have no opinion. So overall, with such a split, although there's a marginal bearish dominance for now, the big share of the sideways traders is telling me that the market has no preference. We don't know where it's gonna go next, and that is fine, because that's what we use technical analysis for, to help us chart the path for the week ahead. And that is exactly what we're doing right now. So I'm just making myself very, very small, and I want you to pay attention to what is happening more recently here last Friday. So on the TTF front month, we have the NBP front month, we have the TTF front season, the NBP front season, we have German power, then we do, no, sorry, that is EUAs, then we have the German power markets, we have the Henry Hub, and of course we do have Brent right here. And you can see all of them moved dramatically higher as the conflict between Israel and Iran was intensifying. But as soon as we had just a little bit of news, even tentatively, even if it was like a taco event, we did see that the news has so the market has dropped significantly. So that is showing me personally that the market is taking its time to push higher, and every single day is a strong consideration of the supply and demand balance. But as soon as there's just a hint of bearish news, even if it is unconfirmed, and even if the ceasefire is very weak and the conditions weren't all that clear when they were first published on X or Truth by Trump, we saw any hint of bearishness, boom, the market immediately took advantage of that. So that is showing me that we are just waiting for any bit of bearish news in order to just get the market calmed down a little bit again. So that's why I'm thinking that overall bearish continuation seems still most likely. Now, yes, of course, looking more recently, we see that last Friday, depending on what market we are looking at, we did see that we ended the week with a little bit of hesitation, especially on Brent here. So it is at a potential bullish turning point, most of the markets, a lot of them, but I think bearish continuation still makes most sense. All right, so let's get started with the TTF front month. Of course, as every week, we are starting with the weekly chart, and here it becomes clear why we have not turned from bullish to bearish immediately, and why we are taking the middle step of being neutral first. So last week shaped up as a bearish engulfing candle. So a bearish engulfing forms at the end of an uptrend. So we have the preceding uptrend, we have a green candle, we gap higher a little bit, we see a little bit more gains, but the bulls can't hold on to their progress, and boom, we end down here, undoing a lot more progress than just the one from last week. So why is that? What is happening now? So this pattern is called a bearish engulfing, and what I want to see next is a weekly close below 32.76 in order to confirm this. So I think for candle patterns in general, it is very important to me that we really wait for the confirmation, because these candle patterns are found to be less reliable than a coin toss at times. So they're still useful, especially for trading setups, and they can help me pay attention to certain market dynamics in the moment, and it's still a very good reflection of what the market is thinking. So it's a super great sentiment indicator, but there is very little predictive value in any candle pattern for the European energy markets, and we know because we've backtested it. So what I always want to see is a confirmation of this bearish pattern. So now we need a weekly close below 32.76. This whole bearish setup would be undone with a weekly close above 42. I don't see it happening, but we have to be aware of the alternative. Now, I am also working with these fib extensions now. So after this down leg here, we had this extensive correction higher, and now we are continuing lower. So this is how I placed my fib extensions from here to here. This is the correction, and now here we continue lower. And you can see the 61.8% fib retracement, extension is at 24.675. I think there's nothing too crazy to look at. What I am not fully in agreement with is the 100% extension target at 13.9. So I don't think we're going there anytime soon. I'm just pointing out it exists, but I don't think it's reasonable or important to think about that right now. Okay, so I much rather focus on this. But of course, we're not making any trading decisions in the weekly chart. For that, we move into the daily chart. And here we see exactly what happened last week. So the bulls were climbing slowly towards the 200-day exponential moving average, and it took quite some force, right? First, we broke above this sideways range that has been dominating for quite some time. We pushed higher, then we didn't really know where to go, but the bulls ultimately pushed towards the 200-day exponential moving average near 41.5. And we had all the conflict intensifying, and Israel and Iran giving it a good go as well. But you can see just with the first hint of bearish news, which was a potential ceasefire, although no matter how fragile it was, or even if it was violated in the first couple of hours, the market was willing to jump on any bit of bearish news to justify a decline again. So that is showing me that the market overall is a lot more willing to move lower than it is to move higher. So I think that bearish continuation is most likely, simply looking at the stochastic, which is not giving us any sort of bullish indication whatsoever. We also see that the DMI is still firmly bullish, and also the MACD also gave us our first bearish signal with the move below this zero line here. We also got a death cross on the 8 and 12 exponential moving average, where we see that yes, the market is pushing lower, but most recently the market is pushing lower even more. So that's a downtrend acceleration, right? So the fast 8 exponential moving average pushed below the slower 12 exponential moving average. So one more sentence on ascending broadening wedges that I want to share with you, and that simply is a very, very difficult pattern to trade. So I just want to put it into context, right? So let's say we have a nice ascending channel and the market is moving higher. We've got our downside corrections and the market is pushing higher. And at some point, as soon as we start moving below the channel, we do get a bearish signal, right? And this bearish signal here is much earlier than the bearish signal we would be getting from waiting for a lower low. low. Now, this is not so the case with broadening wedges, so they are super difficult to trade because the bulls and the bears are equally convinced, and this is increasing volatility. So the legs are getting wider and wider and wider. So out of a sudden, waiting for the market to push below the broadening wedge means that we would have had to wait from here to there before we enter a big momentum trade, right? So we would have given up like this much of the market. Of course, this is absolutely unreasonable. So how do we trade it? For broadening wedges, like rising and also like falling broadening wedges, right? These are also very, very, very difficult. What we want to do is we are not relying for a momentum trade on these here. And for a moment, as we are pushing deeper inside the broadening wedges, I usually tend to abandon any idea of a big momentum trade, and much rather I pay more attention to the peaks and the troughs. So rising or ascending broadening wedges are usually resolved to the downside, which is happening now, but I pay more attention to these reversal points and try to get in a little bit earlier, maybe even on the hourly chart, and then if we are breaking lower, then I'm good to go. I already got in here a little bit earlier. And if we start seeing a bullish reversal candle here, no problem, then we just simply continue with the swings. So this is how I like to take it. I don't take this here as the big momentum trade. I just stick with the smaller swings. And if this happens to work out, then hey, nice. Okay, so what happened here? So once again, we did have a bearish engulfing a couple of days ago. So the market was predispositioned to move lower. So of course, we cannot predict the news. You cannot predict the policies and how war develops. But we did see in the market that the market was ready to push lower. So it looked like we were just waiting for any bit of bearish news in order to just jump in on it. So the market was set up for the bears. We are just waiting for the catalyst. We are just waiting for some news to materialize that would justify the market to push lower. Nobody could have guessed that it's going to be that much of an extreme development. So that's why we saw the big gap. If the news would have been less extremely bearish, then maybe we would have seen a more gradual decline. But it's neither here nor there, it doesn't matter right now anymore. So I want to just share my thoughts on gaps in general. So there is books, traditional literature that is telling us that gaps are always filled. This is not true, and it is very dangerous to have as a standard assumption. So just take gaps as what they are. They are a price vacuum. It doesn't mean that the vacuum is always being filled. There's different types of gaps. We have runaway gaps and breakaway gaps and measuring gaps and all of these. And a lot of them are not filled, to be honest. So how do we deal with gaps here? So what we can do, and let me just quickly take a screenshot here so we can actually draw this scenario. So what we're having is this gap here, let's say from here to there, we are marking this out, right? And as soon as and for now we ignore it, so we don't assume that it's being filled. But as soon as we start seeing that a green candle is closing inside the gap, yes, then I agree. Then it is more likely for the gap to at least be partially filled, and then we can take this boundary here as a target before then the market continues lower, right? So in reality, we would have seen something like this, and then this. Okay, this is fine, but truly the important thing is that we move into the gap. So for the market to be sucked up into the vacuum. But as you can see here, we're just boom, continuing lower. So that's why I'm not really paying close attention to the gap right now. So I did put on also these Fibonacci retracement levels because, hey, last Friday we did end up with a doji, and dojis can set the market up for bullishness. I didn't want to put the R1, so the resistance one here for confirmation. I put a little bit further at a 23.6% Fib retracement at 35.04 because anything within this market is still aligned with a primary direction that will eventually continue lower. The bullish, and it's just noise. The bullish upside correction would only be kicked off above 35.04. And then we can make it towards a 38 and then maybe towards a 61.8, right? But other than that, Probably not so much if you remain within this level here. So that's why I do pay close attention towards these fibs. Now let's have a look at the hourly chart on the TTF front month to see what might be happening next. So you can see we are working with this descending channel, and we were able to point out the channel like fairly early on as it was developing, so well done us. And as long as the market remains within the channel, the bears have a good chance at continuing also on the daily chart. Now you can see even scenario 2, the alternative scenario, is still almost bearish, because as long as the market this Monday remains within the descending channel, and if we break eventually below 32.4, the bears still have a good chance at continuing. The bulls would only be in charge on the hourly chart at least above 34.65. So that's why with this room to go and still being bearish, that explains why we are a little bit sideways inclined on the daily chart at the start of this week. It's because of what's happening on the hourly chart. Now here's the thing. Let's talk about downside acceleration. So if we get a push below the 32.4, which by the way is a move below this trough here from the 5th of May, if we get a move below that, and if we get a move below the channel here, then the downtrend would simply accelerate, right? So we are bearish, but now with a break below this, we're even more bearish than we were previously. So this is this downside acceleration is justified by the DMI, and we also see that a bullish attempt was undone on the stochastic, so we are back below below the 20 level, so we are in oversold territory again. The only thing that's worrying me a little bit is the MACD, which is showing me a slowdown of the downtrend. But the bears are still in charge. We are still well below the zero line here. So yeah, we are still reasonably bearish, but less so. Also, we do see that the 8 and 12 exponential moving average are also still bearish. So everything is showing us more bearishness. There's only a marginal slowdown in the bearish trend overall as shown on the momentum. But other than that, still looking fairly bearish to me. Reach out if you do have any questions, and subscribe to the Clever Markets newsletter if you haven't done so already. Everyone, it's going to be an exciting week, so keep an eye on the technicals. Stay safe out there. See you around, and bye bye.